So this is going to be part 3 of my How I View the Equity Market series. Part 1 was the basics, part 2 is a little bit more in depth, and this is going to kind of be the part of my edge that's more in depth and is something that, you as if you're a relatively new trader, it's not anything that you really need to worry about too much, at least the broader context and the concepts of what I'm, laying out here. But it's also a part of my edge that I think people don't understand, and it's a really big part in why these markets move how they move, and when they move how they move as well. And that's the options positioning from the dealers. That's volatility. That's windows of weakness and windows where we have the flows that support the market, and how that OPEX and expiration can play a pretty pivotal part within the movement of the equity market. And then the second point I'm going to touch on here is the options positioning. When are they appropriate, and when that leveraged exposure, specifically options, is what I'm kind of discussing, because leveraged ETFs are one thing, options are another, right? Options are trading against volatility, trading against time, and they can, their intrinsic value can increase exponentially. The convexity on these is huge, but you can also very easily lose, right? They can become worthless before expiration. And then small point I'm going to touch on is rotations. As far as risk on, risk off equity, how you can kind of spot the red flags in terms of risk on equity being rotated out of, and then money rotating somewhere else, right? Because like I said, people do this to make money, right? People trade equities to make money, and when there's a profit taker in one name, one sector, one asset, one class, they're more than likely is going to be positioning being built out on underperformers, and maybe lower beta names if we're in a risk off environment, right? So the first thing I wanted to touch on is the dealer positioning and the relevance of the options market within the equity market as a whole. So it's a little, I don't really have much of a graphical explanation to show, right? It's more of a conceptual ideology. I do have some examples though, as far as trades that I took, trades that I've seen, and opportunities that I've seen within these windows. But the concept of dealer positioning is a big thing for me. So everybody's long, right? And I'm stealing this from Jem Carson. Everybody's long. If you have a house, you're long. If life insurance, you're long. Retirement, you're long. Everybody is long, right? And specifically with options, like I said, there's attributes and variables at play here that can decay the price and the intrinsic value of these options, and can also exponentially increase them, right? And with that comes movement under the hood that is relevant to why the equity market moves how it moves, and when it moves how it moves. So, for example, we have options. We're just going to go, for example, long positioning on options, right? Now, the liquidity on these options varies on ticker, right? Varies on the name that you're trading. But a lot of times, specifically, we can use the JP Morgan. That actually is something I'm going to pull up. We can use the JP Morgan collar, for example, right? So there's 3 collars. We'll discuss just the main one, where it's rotated on a quarterly basis, right? And the goal of this is to hedge their long exposure on their portfolio, right? And to hedge it so that they don't really take on any risk, but if there's a lot of volatility, they have a hedge and a protection against that vol. And in the case of long equities, they're hedged and protected against the downside. Specifically, in my opinion, a good hedge has a lot of convexity behind it. So the more aggressive the downside, the more lucrative your hedges are to counteract the drawdown in your own personal portfolio. But JP Morgan sells, I think, 45,000 of each. 45,000 puts, 20% out the money, buys 45,000 puts, 5% out the money. Is that it? Wait, hold on. Hold on. Hold on. And then sells an out the money call, right? That out those selling of the options counteract the buying of the puts, and they're hedged between a 5 and a 20% drawdown, right? But what happens, right? Is there, I discussed the auction and how, if you're buying, someone's selling, but who's out there buying 20% out the money puts at a 45,000 lot order, right? There's not really people doing that. There's not retail traders doing that. There's market makers, right? They make the market. In illiquid markets, illiquid names, they make the market. They step in. They make the market. They take on and warehouse their inventory and charge you a fee accordingly. But with that, right, that market maker now has to hedge his own position because they don't want to take on the risk of buying 45,000 puts, 20% out the money, selling 45,000 puts, 5% out the money, and buying, out the money calls. Whatever it is, I'm not 100% sure on what the but there's someone that has to warehouse that inventory and make that market. And with an order, okay, so they sell an out the money call, they buy an out the money put, and they sell a near out the money put, right? So they buy a deep one, or they buy a 5% out the money put, they sell a 20% out the money put, and they sell an out of the money call, right? Where they can fund their own orders. So I'm just using this as an example because it's an extensive amount of options contracts traded, and there's a dealer or multiple that takes on that inventory, right? And with that, they have to hedge their own portfolio, right? Pretty simple concept, right? So they don't want to be exposed to those positions, and they have to hedge their position accordingly, right? And the Greeks on the option contracts play a big role. So we have delta, which is the change in the price of the contract relative to the movement of the underlying, right? The delta is equal to change in the contract relative to a $1 change in the underlying. We have gamma, which is the change in delta, which is the second order derivative with respect to the change in the underlying. We have theta, which is the decay of the option. And then we have these Vanna charm flows, right? Where it's another second order derivative, right? That is moving against time and volatility, right? So Vanna is the change in the delta with respect to implied vol. Charm is the change in delta with respect to time, right? So when those kick in, and when implied volatility moves and time decay kicks in for that delta specifically, there is buying or selling of the underlying of those market makers of the futures to hedge their positioning, right? So if JP Morgan buys 45,000 calls and State Street warehouses those 45,000 calls, sells them, they're going to be negative delta, and they're going to have to hedge their position to a delta neutral exposure so that their position doesn't fluctuate and they don't lose money, right? They're just a market maker. They make their money on payment for order flow, and they make their money on the spreads, right? But with that, and with such an increase in influx of interest in the options market and trillions of dollars being traded in this market specifically, we have, that going across hundreds of funds, hundreds of portfolios, thousands, millions. And so with that becoming very relevant, we have a lot of hedging via futures based on the movement of the delta, right? Because delta is the change in the options contract with respect to the movement of the underlying, and when the underlying moves, the delta moves, and they need to hedge their position accordingly. So as we approach the expiration, right, the expiration being the third Friday of every month, the expiration being the third Friday of every month, those Vanna-Charn flows kick in, right? We also have Vixpiration, which is the expiration of volatility instruments. Volatility, VIX specifically, being derived from 30-day out SPX options, right? So, the implied vol, the more people that buy them, the higher the implied volatility goes. Put specifically play a big role in that. But we can see here, blue, monthly settled index options, or monthly equity index and cash settled currency options expiration date, the third Friday of every month. Volatility product expiration date, Tuesday or Wednesday, that week or the following. I think it's 30 days after the expiration. And those play a big role, right? Because as we trade closer to that, as we trade closer to the expiration, and these contracts are subject to more volatility, more uncertainty about where we're going to close at, the hedging exponentially increases, right? And as those kick in, those kind of that week before and the week of is what I'm really interested in. Those Vanna-Charn flows play a big part, and those can pin volatility, right? Because depending on the dealer positioning, they're going to either have to sell into the rips and buy into the dips, which can pin the market, which can pin vol, because of their positioning, right? If their delta rises, they sell. If their delta drops, they buy to hedge their position. Or we can exacerbate these moves if their delta, if depending on their delta positioning, they sell into the rallies and they buy, or they sell into the dips and they buy into the rallies, right? Depending on, if they're long or short gamma, and that can exacerbate these moves, right? But what I'm primarily focused on is the window of strength that occurs the week before and the week of the expiration, right? And this essentially is relevant because you'll see these moves, right? And you can see these moves happen. You can go back and you can backtrack, and I'll discuss my own personal trades that I've taken within these windows, where post options expiration, we see increased volatility. We see aggressive moves most of the time to the downside. Obviously, some of the times the unpinning of vol within that window will lead to moves to the upside, right? If we go back to COVID, we had the February expiration, the aggressive breakdown, and then this was the March expiration, right? And this led to the rally and the reversal that we have. And that plays a big role because volatility is unpinned. We have these positionings unwinding. This is a quarterly expiration as well, which plays a big role. December as well as a large index expiration, January being a large stock expiration. And so those quarterly expirations, those end of year, beginning of year expirations play a big role in the movement of these markets because you can see pinning of vol as we approach that window and unpinning of vol as we exit that window, right? And that's why that window of weakness is primarily labeled as, post expiration up until the second week of the next month. And it's something that I use in my trading a lot. It's something that I think a lot of people don't understand. Here specifically, right, we had March OPEX, we had the continuation, we saw this exhaustion and this lower high put in on this previous floor established off of the election gap, January 13th, and then we see a decline, right, and we see this decline into April 7th. And what's April 7th? Well, April 7th was the introduction of the April Vanna-Charn flows, right, and the buybacks occurring with those dealers' positionings needing to be hedged. And I shorted NVIDIA and XLF this week, and then I longed SPY QQQ this week. And it's not really a big surprise, right? It's not really a big surprise. Here, when we topped out in February, this was February of expiration, right? This was the expiration of the volatility products, potentially leading to volatility becoming uncompressed. And then we see the decline happen. February OPEX being that initial 1.7% red day, marking the top for the time being. It's important, right? We had December of expiration, right? This led to a 3% decline off of the Fed meeting, right? And it's no surprise that we see volatility kind of lacking up here. We don't see a clear directional read. And when those flows are gone and exit the market, we see an aggressive move to the downside of 3% in one session, 4% into Friday's session, right? August 5th, we had the major change of hands, the massive capitulation, changing of the hands. And then we see those August flows into the market. We see a really aggressive rally, consolidation as we digest this massive rally and a higher low that's put in. And I guess this was September OPEX. And this rally leads into September OPEX, right? This is the introduction of the September flows on the 9th. We see a really clean rally. And obviously this was a little bit of a different time and environment. And it's not always going to be perfect, right? You're not always going to get declines after expiration, rallies into expiration. But more oftentimes than not, as we can see in August, as we can see in September, as we can see in December, as we can see in February, as we can see in March, as we can see in April, as we can see in May as well, we see the 3% gap up on May 12th. We see the continuation and the relatively, passive selling behavior and the lack of follow through up here and the decline that's potentially needed to digest this rally. We see OPEX happen on the 16th. Immediately after, we see a 1% decline in after hours. A digestion of that move, we take out those highs, fill the INWOG, and then we see a pretty clean 3% breakdown with the 21st being expiration happening after OPEX that week, giving you a really clean intraday move off the bond auction and giving you a 3% decline in a matter of a couple of days. I shorted this as well, right? And so happening in May hasn't necessarily happened super aggressively in June or July, but this is a Summer of George scenario, which is a topic that has to do with so like I said, at the end of the year in December and at the beginning of the year in January, we have these large expirations, right? And these large expirations in a window of a bunch of holidays, right? Christmas, Thanksgiving, New Year's, Martin Luther King Jr. Day. We have a low liquidity environment where there's a lot of, just in general, a lot of people taking off, a lot of people not trading. And when there's low liquidity and these flows are very aggressive and very notable, you have the potential to see first of all, dispersion, right? Where dispersion is that pinning of the indexes and the movement away from each other as far as constituents, right? We have, if indexes aren't moving, something's going up and another thing's going down to kind of counteract that and pin the indexes, right? And that's what happened during the summer. That's what kind of happens during that end of year, right? Obviously, it's not going to happen every time. Past 2 summers, we've had that environment. But it's summer especially. We have a lot of holidays, May, June, July, April, May, June, July, 6 or 7 holidays. And we have low liquidity in these environments. We have people on holiday, people taking off, right? People that aren't necessarily trading aggressively within these windows, right? Within, the summer, within the end of the year and the beginning of the year. And so that can lead to these flows being very aggressively important in the movement of the market, right? That can lead to these flows having a very aggressive impact on the movement of the market because of the low liquidity and because of the relevance behind these flows. And I view this specifically, this rally in April to now currently in July, where I think we're topping out. We saw the massive reversion in April, and we see this consolidation, and we see this lead into the summer. And when we see this massive vol event, and we see a lot of buying happen down here, and a lot of options buying specifically, this can cause this rally backed by movement under the hood that you don't really get to see just looking at the chart, because of the consistent hedging. And as those calls go further in the money, the delta kind of increases, and we have further buybacks happening off dealers. But we're now entering a window where, the summer's ending. Those holidays are gone. We don't have as many holidays. And we're seeing this stall. We're seeing this potential top being built out. This week specifically is July expiration and July expiration. And the way that this is setting up into that window, similar to in May, makes me think we get a little bit of a decline personally this week, right? Especially when we see the stalled progression, the selling happening at the new highs within this range, almost like a 3 higher high distribution into Vixpiration. QQQ, we see the accumulation within this July 9th gap, a gap up that stalls again, and we have these kind of exhaustive tops being built out into a window of vulnerability short side. So it's not always going to happen, right? We look back, we see the rally we had in October to January or to March. A lot of this was backed by the dealer positioning. A lot of this was backed by the window that we were approaching. And another concept I want to touch on is rotations. So this is very evident in quarter 1 of last year. I'll talk about energy. I talked about energy accumulation throughout quarter 4 of 2023 into quarter 1 of 2024. In the rally, we had a 20% rally from January lows to April highs. And you'll note the outperformance of the S&P 500, right? You note this rally, right? And then we lead this rally into quarter 1 of 2024. Similar to this year, we begin to see that distributive range top out, right? We see the highs sold off, we see the exhaustion occurring, we see no clean, aggressive pullback that was really evident. And we see a lot of tech leaders distributing, right? We see AMD forming that distribution in quarter 1 of last year. We see NVIDIA kind of giving you a really aggressive March 8th liquidation and then a subsequent digestion of that candle. And we see the rotation happening. And we see this rotation happening after a large single stock expiration in January into February/March, where we then see those kind of beginning of the year flows leave the market. And we see a pretty quick decline. This leads into that summer rally that we see, very similar to this year, April into July. And then we top out and we see the massive breakdown and the changing of the hands from the April rally, which I don't think something's going to happen like this again. But it's very similar to this year, where we had the stall at the beginning of the year. We had DeepSeek kind of be that first domino to fall, and then we had the decline post-February expiration. And as we lead into the summer, we have that summer of George. And this is not always the case, but sometimes, especially in an environment like this, where there's a massive footprint and large buyer down here, it oftentimes is the case, especially when there's a sequence like this that happens when we get this quick decline and aggressive follow through, right, as well. So you look at SPY, you see the relative stall happening post January expiration, and we look at energy, right, and we see the rotation into a sector that's been, kind of lagging, primarily in the October to November range, lagging, in comparison to the broader market. But we see the accumulation happening. I discussed this, and the outperformance of this sector, and that's just that rotation, right? This is that risk-off lower beta sector, seeing money rotate into it after an aggressive rally on those risk-off names and those profit takers in those names, rotating cash into the underperformers. And it's pretty simple, right? The window that it happens in, we see this aggressive rally into the summer. We see the breakdown on some equity, some tech equity into April, and then we see the reversal, and we see the rally in the summer into July expiration, right? So, that's about as deep as I think I can go here. Pause. Just the windows that we have being very pivotal, understanding why sometimes this option positioning in windows play a very big role in the movement of the equity markets and the pinning and unpinning of volatility, and understanding how these moves can be exacerbated, can be set off, can be sparked by the expirations that we have. And, the fact that it's not random. I just named, 5 or 6 months in the past year where it was very evident that once those positionings came off the table, we were going to see, when that window opened up, we saw a lot of weakness, right? And it has a little bit to do with volatility right now. Volatility, like I said, VIX is a direct derived from the S&P options positioning, right? We see this rise when a lot of puts are bought due to the implied vol on those puts being higher than the calls. And, obviously we see in August of last year a very aggressive rally on volatility. We see that influx of vol into the market. We see the same thing in April as well. And then we see the compression of vol. And it happens it happened over the summer, and we see this very aggressive spike. It's happening now. And it happened post December rally, a breakdown, and we see the aggressive rally on VIX. And that compression of vol after such an aggressive move plays a role in the dispersion in the individual constituents within the equity market and the kind of lack of correlation and notable underperformers and outperformers, right? We can look right now and we can see a lot of tech names outperformed, a lot of consumer names, right? You look at, Kraft Heinz, right? Wendy's, right? McDonald's, right? Macy's, right? Oh, Macy's had a big spike on Monday. Okay. Oh no, why is this? Macy's, right? These are all relatively underperforming. Not only one relative to where they're at within the charts in their April gaps, but some of these, taking out, healthcare, right? A lower beta sector taking out those April 7th lows. XLP not necessarily performing the greatest. And at some point, we're going to, in my opinion, see these laggards catch up. And I think there will be a lot of signs, and there are a lot of signs that that's going to happen. As far as profit taking on the leaders and rotation into the laggards, where there's interest in those names, right? So, I feel like that's all I can discuss, right? The relevance, what those dealers are doing when they warehouse that inventory, when the windows are appropriate, and kind of the rotations that happen, right? You'll usually see signs that that's going to occur, right? I think we're seeing signs right now, but like I said with Nvidia, right? We see the signs in June and July. We see the breakdown, right? And you look at the notable weakness on Nvidia, right? You go look at J&J during that window, right? J&J was really aggressively moving from 144 to 165 on August 5th, right? Where Nvidia was breaking down from 140 to 90. You see PEP, right? A lower beta risk-off consumer name that rallied in July to August. And then we see this instead of what we see on these tech names in August, right? Where we see this aggressive gap down that sees a large buyer and subsequent higher low put in September. We see an aggressive rally where that August 5th print is where a larger seller comes in, right? On a notable sector that was, outperforming, up 15%, while we have Nvidia in June to August down 40. So during those times of weakness in the risk on names, you'll have strength in the risk off, and that's a big key component to what I trade and why, in my opinion, right? Now, the next thing I want to discuss a little bit is the options exposure, right? So I personally believe that options are a phenomenal tool, right? I think there's a time and a place for them. I think they're a phenomenal tool to capitalize on increased volatility. And if you think something's going to happen within a certain time frame, you can execute accordingly. But with that comes playing against time and vol, right? Playing against time and volatility can often result in expiring worthless, or options expiring worthless. And that's where the structure comes in, right? That's where the risk to reward comes in, because like I said, the convexity on these instruments is very high. The potential for these to exponentially increase in value is very high because of the Greeks and the movements of the Greeks relative to the underlying. And you can capitalize on that, but it takes time and experience within these markets trading these instruments to really understand when the timing is right. I think that there's a time for short expiration. I think there's a time for a couple weeks to a couple months out, and I think there's a time for leaps. Now, that short expiration, right, is more of an intraday positioning, right? If I am, let's take SPY for example. Let's take SPY in June, right? The preliminary signs of the buyer down here showing on June OPEX, and then we had the rally post June OPEX and the quarterly expiration. If I'm longing this position right here, the proper expiration for me is, on an intraday trade off 593 is weekly expiration, or maybe next week out, with the potential to swing overnight being based on the leeway and exposure that I have, right? So what I mean by that is, if you're looking for a move, a 2 to 3 point move on the index, 3 point move, 0.5%. If you're looking for a 0.5% move on the index, you're not going to buy a month out, right? You're not going to buy a month out because is the risk to reward in your favor? With the options exposure, you have to be a little bit more keen to note the risk to reward, one, and you have to be able to, the timing aspect as well has to be crucial. If I'm taking, if I'm looking for a 0.5% move within a day, maybe two, I'm going to take, a week or two out. But if I'm looking for, a decline up here to lead us to 600 to 564, 580, that range, 5, 6%, 10% decline, I'm not going to buy 2 week outs, right? Because those are going to decay really fast. And yes, the potential for those to really increase in value exponentially is there, but it's not the correct use of this instrument, in my opinion, right? I don't want to buy an option and just look away and wait. I think you can do that. You can have a specific strike price. I think this ends up in the money and by this time. But me personally, when I use these tools, I don't want to trade them in the money. I don't want to execute the position. I want to capitalize on the volatility, get in, get out in a relatively quick time, depending on the expiration I have, right? So it depends on the trade you take. Like I said, my Nvidia position that I took in January, right? I took this kind of consolidation of this massive footprint, the very weak bid, and the path of least resistance being established. I took April exposure here, targeting 130, right? And we ended up trading 17% the next session. I obviously could have sat here and bid bi-weekly expiration. Those ran a couple $1,000%, and I make so much more money. But if I'm trading bi-weekly over the weekend, the decay is going to hit if we don't really open that red. I'm going to be underwater potentially. Obviously, I had 30% leeway. If I had 100% leeway on next week expiration, it would have been a decent potential swing. But you also have to understand that risk to reward matters, right? Like I swinging a bi-weekly position here, looking for 130 is a little bit extensive, right? Because you're looking for a 13% decline, 15% decline for my entry within a week. And obviously we met that, but taking the more passive approach, buying a couple of months out is a little bit of a smarter play because the data's not as high, you're not going to decay these contracts as aggressively. So yeah, these ran 300, 350%. Great trade. I could have made more, but the risk to reward is not there for me to, swing bi-weeklies here. And the mental capital as well is not there as also, right? But if I'm just trading this, I took a trade this day from the progression gap into the, gap that we had established that Wednesday. I took next week expiration. I took 7 DTEs and those ran a couple 100%. So there's a time and a place for options, and there's a time and a place for certain expirations and certain aggressiveness behind those positions as well, right? So that's something I wanted to touch on. Like I said, these are very good instruments. Another thing I want to touch on is the reversion trade that we had in April. So volatility, right? When volatility is high, that means that the expected move is aggressive. And if that move is not, expected move is exponential. And if that move is not met, those contracts are going to decay aggressively, right? So leading into April 7th, we had VIX at open on April 7th at 60, right? Which, as we can see here, is very high, right? We've only seen that a few times. We saw that in the financial crisis. We saw that in 2020. We saw that in 2024, and we saw that here, right? Those are the only four times we saw VIX at 60 since the 1990 and beginning of VIX, right? As far as this trading view chart goes. So down here, right? I traded options on this April 7th move, from like 484 up an 8% rally. Those only ran a couple 100%, right? Because that implied volatility was so high, because those contracts were juiced, right? When the implied vol gets really high, the contracts get juiced up. That's why I'll talk about the reports and the flushes. But because of that, I viewed the risk to reward on options maybe not the best on here, right? I viewed the leveraged ETFs a little bit better of an exposure because you don't have to worry about vol getting crushed and a movement in the underlying happening, but you're not getting the expected return you want. So this session, right, we declined 1.5%. I was still very bullish. There's a very clean structure throughout here. And, even as we're trading lower, my options aren't decaying that much. I cut that position and I flipped TQQQ, which gave me a 30% return in a session and a half. But obviously, hindsight's 2020. I cut that position because of how volatility was trading, right? With such a high VIX, if we see that move happen, but it takes a little bit, especially with CPI that following Wednesday, and it takes a little bit, you're not going to see the return that you want. And it's not necessarily worth the risk to reward isn't there to trade options when implied volatility is that high, So things like that, right? Hindsight's 2020. Those calls ran aggressively, a couple 100%, and I missed out on some money. Still made some, but I cut that position and flipped into leverage ETF exposure because when we trade higher, VIX declines, right? That just has to do with the positioning on 30-day out SPX options, and buying puts and the implied vol is higher. So my long thesis was there, and obviously I could have traded options and leaned towards the leveraged ETF on April 9th because of where VIX was, right? Because of the, potential for those contracts to get crushed, I lose a lot of money, and even if the move happened, if it didn't happen on the 9th, if it happened the 10th or the 11th, those contracts would have been crushed if we just traded and consolidated and volatility declined for a little bit, right? So, there's a time and a place. Obviously, this was a great place, but was the time there with how volatility was trading? It was, but you have to think about risk to reward, and you have to think what the best opportunity is to make your job as easy as possible. So there's that. Another thing I want to touch on is earnings, right? So sometimes you'll be bullish to chart for the report, right? Like I think NVIDIA beats their, I'll go back here. Prior to this February 27th report, I was very bearish on NVIDIA. We had the weak float in the February OPEX. We had the top on the broader equity market. We had to fill the deep sea gap, and we had a really quick decline with a weak bid. I thought that NVIDIA was in decline. Now, did I buy options before the report? Absolutely not. What did I say about the reports being very aggressive counterparty liquidity generating events? Say that 5 times as fast as you can. They spark a lot of buying and selling and potential counterparties. But leading into an NVIDIA report, a very liquid name with a high beta, your implied volatility on weekly options on, at this point, 1 DTE options a couple weeks out as well, as we trade further out, they're not going to be as juiced up because the report's not going to have as much meaning towards, in February, that February report's not going to have much meaning towards the May expiration. But those weekly and bi-weekly positions, the risk to reward's not there because if that implied move is not met off open, which was probably about 10%, those are going to get crushed, right? But that's where I step in, right? When I discussed this trade, part 2, I shorted that whole 11% decline on 1 DTEs and on a couple weeks out. And the reason that those ran so aggressively is because the crushing of those contracts, they did not meet the implied move. They were very juiced up. They crushed. And then we see the aggressive move to the downside. And then we see that, couple 100% increase, I think 600% increase on those positions on 1 DTE because of how crushed they are. And then we don't meet the move. We open up flat, and you can buy those for very cheap, and they can move aggressively. Like I said, that convexity on an earnings report where there's a lot of liquidity generated. So that is a time to use options on an earnings report. If I would have just bought puts, maybe by end of day they would have been green, but off open they would have been insanely crushed. And that's where a lot of people get it twisted, in my opinion, on the options, especially in the binary events, right? if there's a big event, FOMC, CPI, earnings report, the implied volatility is going to increase. There's going to be a lot of buying on options, a lot of speculating, a lot of hedging, and if that implied move is not met, those contracts are going to crush. They're not going to meet that move, and they're not going to meet the implied move, and we're going to see those decay, and then you have an opportunity to buy them. And then you have an opportunity to make even more exponential returns because of how crushed those contracts are. So yeah, I mean, that's kind of all I wanted to touch on in part 3, right? What are the options flows and how do they impact the market in terms of moving or pinning the market one way or another? The summer of George, the end of year and beginning of the year rallies and flows, the dispersion between individual constituents, and then leading into some options ideology, right? When are options appropriate? What positioning is appropriate for when? And the earnings reports behind those as well. And I touched a little bit on rotations as well. I could definitely find more examples of intraday trades I took, right? Down here or over here at 576 and 492 on Qs, I longed it this day. But I longed it on, weekly or bi-weekly expiration looking for an intraday move, right? I didn't, if I longed it on bi-weekly expiration, I'm not really going to build out a massive swing here and try to target, 520s. I longed the intraday move off of a gap fill on a pivotal spot where we saw a big buyer and a reversion was potentially needed. If for some reason you were to look back or you were to look here and you wanted to build out a swing to target 520 or even new highs, if you were very bullish over here, the play is multiple weeks to multiple months out, right? If you think I took a bad trade over here, I just entered it a little too early, but we had this bottom building out in March and reversion of the gaps potentially necessary. There's a good long opportunity here. And it's really relative to what you're looking for, right? If you're longing the sweep of this Tuesday low on Thursday, looking for a nice pop on the Friday session, that's clean. If you're longing this looking for 492, looking for 576 again, you need a couple of months out. You need to let it digest and you need to, trim appropriately and re-add appropriately, targeting that gap. But you're not going to do that on weeklies, bi-weeklies, even 2-week outs. It's just, you're not going to profit as much and the risk is going to be higher because of volatility and time, right? As time goes on, they lose intrinsic value, and as volatility moves, those contracts are going to move. If volatility decreases, vega, which is the change in the delta, which is the change in the options price with respect to volatility, right? If we see volatility decline, those options prices are going to decline, and that tends to happen. It's especially for holding a position for a while. You're going to get eaten up by those, right? So maybe not the best video. I definitely feel like this could have been a little bit better, but I feel like a lot of this is very conceptual. A lot of this is very hindsight, right? I did kind of talk about the July top that I think is happening here into this window of expiration and OPEX, but a lot of it is very time-based. Like you have to look at these things, look at these windows, have an idea, and see if it plays out or it doesn't. And I think that's the big thing here, right? But I think that there's an edge developed in the positioning of dealers and market makers being very pivotal to the movement of the underlying, right? And maybe the non-movement of the underlying, right? So I think that's a very big factor and a very big part of my edge, but also sometimes those can be, they can be the opposite. We can have negative vantage farm flows where, like I said, they're selling into those dips, or maybe they're hedging their positioning by selling the underlying, depending on their delta exposure, their gamma exposure. But the concept is what I like to touch on, and the context as well, right? I think the context in February was there, the context in March, the context in April, the context in May, and now the context in July, right? In December and in August and September. It's important to understand where you're at and why you're at, form your thesis, and then base these topics that are maybe a little bit more speculative, because I personally don't pay for data. If you pay for data, maybe you have a little bit better of an idea. A little bit more speculative and a little bit more, building off of your thesis that you have based on the chart and the broader market as a whole. But discussing that, and then when options are appropriate, I touched a little bit on that. I think it's all going to align a little bit in the next video when I discuss my own personal trades that I've taken, as far as when I did this, why I did this, and what options expiration I took. But I really wanted to touch on the topic today of, you know, what the appropriate expiration is for options and when the appropriate time is, right? Like I said, if you're building out a bi-weekly position from July 3rd till now, you're probably eaten up, right? Or like if you're building out July 18th expiration, you're probably down 50-60% if you built them out on the 3rd and the 2nd, even just the 3rd in general, even though we're, decreased from that underlying price, about, 0.5%. It's the time and volatility, right? And plays a big part. So that vega and those vega and vega and theta, right? So it just plays a big role, and obviously these can move exponentially closer to in the money, but the risk to reward isn't there for July 18th positioning. Sometimes, I mean, it depends. Honestly, it is depending on when and where you bought it at. But like today, like if you're looking for a short today off 626, you're looking for a fill of the gap, and you're taking this lower high. I'm not taking 2 months out. I'm taking a week, maybe even weeklies. Targeting a 0.2% decline. So that plays a big role as well in my positioning and why. Like XLF over here, I took April's, but I covered them all on this day, and I think they went back red, and then they went green 500%. If I take, but also, this was a lower high, and we never breached in the election gap. I feel like I should just talk about this in the next video. I'm just not going to talk about this. I'm going to discuss my trades in the next video. I think it'll all align a little bit, right? I think this is the basics of options flows and market maker positioning, and when options are appropriate. Next video, I'm going to discuss a lot of my own personal positioning and why I did what I did, when I did it, and how I did it. Why, when, what, how, and who. I guess, me. So why, when, what, and how. And I think it's all going to align with, the March shorts I took, the May shorts I took, the April longs I had, why I did that, when I did that. And it's going to really align with the concepts I talked about the first two videos, as far as, technical analysis, volume, price action analysis. But it's also going to touch on this topics: dealer flows, market maker hedging, volatility, increasing and pinning and unpinning movements in the equities. When I took this options trade and why, maybe some that I took that were bad because I was too aggressive and too early and didn't really time the positioning correctly and got paid for it. And then, the rotation aspect as well is just kind of seeing that risk on and risk off, and that dispersion as well playing a big role. So, excuse me. That's going to be probably it for this one. I think it's going to all make sense to me and anybody that ever watches this, which is probably nobody, when I align these all for my own personal trades, because it's going to touch on the positioning that I took, the expiration that I took, and why I took that expiration, looking for what move, and the window that I took them in, and where, and why, and how, and what as well, right? Like, why I was very bearish in quarter one, and then you're bullish down here, but down here I'm not longing pep. I'm not long in pep down here. I'm not long in, like I said, like McDonald's. I'm long focused on these risk off names because we're going to see that influx of liquidity as well. So that's pretty much it. I am going to go a little bit. I think next video will make a lot of sense, but it's also no surprise. Financials and technology being the largest two holdings in the S&P 500 index. There's a big red flag for risk on assets in the broader market when you see XLF and XLK looking pretty gross. And then you see XLP and XLY underperforming, but seeing money potentially, or XLV potentially rotating into them, right? So that's kind of the rotation aspect, right? Where you're always going to have underperformers and outperformers, but oftentimes, more often than not, when those outperformers are topping out, we're seeing that profit taking happen. We're going to see the outperformance of laggers like we did in Q2 in July to August of last year, and then we see in contrary to like I said, J&J, contrary to Nvidia building on a bottom after a 35% decline on J&J on Nvidia from June to August, J&J was up 20%, 15%. PEP was up 15%. Energy was not really performing the best, but it had a pretty decent structure. Was up 6%, right? So it all kind of makes a lot of sense, and I think it's all going to kind of align. Next video when I'm more in depth on the trades that I took, but I'm just touching on basics of these concepts here.